Here's our roadmap of the swipe. When you're standing at the grocery store, tapping
Welcome
your
to this
card.
explainer. So what if I told you that one small, completely ordinary piece of plastic sitting in your wallet right now has the power to either make you incredibly wealthy or keep you trapped in a cycle of debt for years? Look, Americans are currently sitting on over $1 trillion in credit card debt. That is a massive number. But here's the crazy part. At the exact same time, savvy users are cashing in billions of dollars in free flights, luxury hotel stays, and cash back. It's a total paradox, right? Every single day, millions of us swipe our cards without even thinking twice about it. But there's a huge, fundamental divide in what happens after that swipe. Today, we're going to figure out exactly why that is.
To really understand how banks make those billions while other people literally fly for free, here's our roadmap. We'll start with the truth about credit, then look at the minimum payment trap, pivot over to the bright side, and wrap up with the absolute non-negotiable rules for mastery. Okay, kicking things off with Section 1, the truth about credit, uncovering the reality of the swipe.
Millions of people use cards every single day without a second thought. I mean, think about the card in your pocket right now, or that ultra-convenient Apple Pay double-click on your phone. The ultimate question you've got to ask yourself is whether that tool is working for you or against you. Is it a wealth builder or is it a debt trap? The plastic itself, completely neutral. It genuinely doesn't care. It really all comes down to understanding what a credit card actually is at its core.
Simply put, a credit card is just a short-term loan from a bank. It is absolutely, positively not free money. When you're standing at the grocery store tapping your card, you aren't actually paying for those groceries right then and there. The bank is fronting the cash on your behalf. Now, you usually get a 30-day grace period. And here's the magic: if you pay the bank back within that month, the loan is completely free. No fees, no interest, nothing. But if you don't pay it back right away, well, that's exactly when the trap springs.
Which brings us to Section 2, the minimum payment trap, and how banks make their billions.
Let's ground this abstract trap in reality, all right? Imagine your old computer suddenly dies right before a massive deadline. You panic, you rush to the electronics store, and you swipe your card for a brand new $1,000 laptop. Problem solved, right? The crisis is averted, and you head back to work feeling great.
But a few weeks later, your statement arrives, and it prominently displays this seemingly helpful little minimum payment of $25. It feels like a massive relief. I mean, you only have to part with $25 to keep the laptop. But here's the brutal mathematical reality. With a typical 24% interest rate, paying only that tiny minimum means it's going to take you over 5 years to pay off that single laptop. And thanks to compounding interest, which is basically just the bank charging you interest on top of your previous interest, that $1,000 laptop will actually end up costing you closer to $1,700. Make no mistake, the minimum payment is mathematically engineered to keep you in debt for as long as humanly possible. Multiply that exact scenario by millions of everyday customers, and you can see exactly how the banks rake in those billions.
And this perfectly illustrates the debt snowball. You see, it almost never starts with one massive, completely reckless purchase. Instead, you carry a small balance on one card, then maybe open another one to handle a new, unexpected expense. Suddenly, the interest is growing way faster than your payments. You eventually hit this point where your monthly payments aren't even touching the original balance. You are simply paying the bank a massive monthly fee just to tread water. You've officially shifted from paying for physical things to just paying for time.
But why does this happen so easily? Well, researchers have looked into the massive psychological difference between handing over physical cash versus swiping plastic. If you have to pull out a crisp $100 bill for dinner, your brain registers literal psychological pain. It actually hurts. You double-check the receipt, you feel the loss. But tapping a colorful piece of plastic or double-clicking the side of your phone, it feels like magic. There's zero friction, which effectively tricks your brain into spending money you don't actually have because there is no immediate sense of loss. That seamless, painless magic is exactly why these tools are so powerful and simultaneously so dangerous.
All right, let's switch gears to Section 3, the bright side, taking your power back.
Because listen, credit cards are not inherently evil, and you absolutely have the power to turn the tables here. When you are a responsible user, you unlock massive benefits. First off, you build a strong credit history, which is absolutely crucial for buying a house or a car later in life. You also get critical fraud protection. Think about it. If someone steals your debit card info, they are draining your actual checking account. Your rent money is literally gone until the bank finishes its investigation. But if someone steals your credit card info, it's the bank's money on the line, not yours. Plus, you get extended warranties, and you earn cash back and travel rewards. You can literally flip the script and earn free flights to Europe or hundreds of dollars in cash back just for buying your regular everyday groceries. The absolute non-negotiable keyword here, though, is responsible.
So how do we do that? Section 4. Rules for Mastery, Becoming a Smart User.
How exactly do financially successful people earn those amazing rewards instead of paying crippling interest? Well, they do it by strictly treating the card as a routing tool rather than extra income, and they adhere to 4 incredibly simple rules. Rule number 1, only buy what you can already afford. If you don't have the cash sitting in your checking account right this very second, do not swipe the card. Period. Rule number 2, pay the balance in full every single month. Honestly, just set it on auto pay so you never even have to think about it. If you do this, your functional interest rate is literally 0%. It totally doesn't matter if the card has a 30% APR because you will never pay a single dime of it. Rule number 3, never miss a payment because protecting your credit score is vital. And rule number 4, keep your spending under control. Remember, it's just a safer, more rewarding way to route money you already possess.
The real secret here, what this whole explainer boils down to, is that the exact same piece of plastic rewards financial discipline with free perks, but it severely punishes carelessness with years of stress and debt. The difference isn't the card itself, it's how it's used. The very same piece of metal or plastic that earns one person a free family vacation can plunge another person into a decade of financial struggle. Credit cards don't have a morality. They are neither good nor bad. They are simply financial amplifiers, magnifying your existing habits.
I want you to burn this quote into your memory. You're not spending money, you're borrowing it. The next time you step up to a register to swipe your card or click checkout online, stop and ask yourself, is this swipe building your financial freedom, or is it just padding the bank's bottom line? You are not spending money, you're borrowing it. And that one small shift in mindset, it could completely change your financial trajectory. So who's really profiting the next time you tap to pay?